This is Fintech Insider News. This week we bring you ClearBank secures its Dutch banking license to fuel its European expansion. We are joined by their CEO to find out more. UK fintech investment almost triples year on year, up to 5.7 billion in the first half of 2024. And GoHenry partners with Google to integrate kids-focused tap to pay into Google Wallet and Fitbit in the US. We discuss all of this and much more on today's show, so don't go anywhere.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Hello and welcome to episode 889 of Fintech Insider. I'm Kate Moody, Customer Strategy Director here at 11FS. I'm joined this week on Fintech Insider News by three brilliant guests who are here to break down the biggest stories from the past week in fintech and financial services. First up, a very warm welcome back to the podcast for Charles McManus, CEO of ClearBank. Charles, great to have you back on the show as always. Again, we'll talk a bit more about ClearBank shortly, but would you mind giving our listeners a quick intro to you and ClearBank, please?
Absolutely delighted to be back again. Love the show. Hi, it's Charles McManus. I'm CEO of ClearBank. I'm one of the original founders back in 2016. We had the first track line of the first new clearing bank in 250 years. Delighted in relation to the news we're about to talk about today in securing our European banking license. So look forward to talking more about that.
Awesome. Yeah, I'm sure it's been very, very busy times for you and the team. So thank you for taking the time out to come and chat to us. We're very excited to have a Fintech Insider debut for Perez, General Partner at Foxe Capital. Really great to welcome you to the Fintech Insider community, Kyle. Can you tell us a bit about the work that you do at Foxe Capital, please?
Absolutely. And thanks so much for having me. Been a long-time fan of the show. So Foxe Capital is a fairly new venture fund. My partner, Foxe Bittner, and I started the fund back in January of 2024. And we are an early stage fund focused primarily on the world of financial services. So we define that fairly broadly. So direct fintech, insurtech investing is very much fair game for us, but we'll often find ourselves investing in sort of adjacent spaces where there still might be some form of payments, insurance, lending, risk management, you name it, sort of financial components of businesses. Very early stage focus for us, so mostly pre-seed and seed stage investing, writing checks from $500K to about $3 million. And we are very open for business. So appreciate the time.
Awesome. Yeah, thank you very much for joining us. And last, but definitely not least, we're joined by Maia Bittner, investment partner, XFactor Ventures, and host of the Artificially Intelligent podcast. Maia, always great to have you on the podcast. What have you been up to since we last spoke to you on Fintech Insider?
Yes, so excited to be here. I feel like I live and breathe fintech, investing with the podcast, working, founding companies. So we've got a good news week this week, and I can't wait to chat through it all with you guys.
Yeah, it's a chunky one. Definitely one of the ones where we were struggling to kind of work out what to put in. So, okay, well, on that basis, let's jump in. So our top story this week has come from Finextra, but covered in multiple places, and that is ClearBank set for expansion after securing its European banking license. The specialist challenger bank is poised to offer Euro accounts after the European Central Bank approved its license with oversight from the Dutch Central Bank. This will enable real-time clearing and embedding banking services to compete with the legacy tech of incumbent banks. It's all part of a big push from the bank to make inroads in Europe, with plans to expand their European HQ in Amsterdam to 60 people, 60, by the end of the decade. We're very lucky to have ClearBank CEO Charles McManus on the panel with us today to tell us firsthand. Charles, I'm guessing this is pretty exciting news for you and your team.
It really is. It's something I've been passionate about, and politics aside, but essentially sort of post-Brexit, a UK bank going into Europe to actually getting a banking license in Europe, a full banking license rather than an EMI or e-money license to a number of your listeners. It's taken us, 18 months. A lot of hard work, 2,650 pages, all the boring stats. We did it to get a UK banking license. Not an easy thing to do. And yes, in dealing with the European Central Bank and also the Dutch National Bank, the DNB, it's been a really exciting ride, and just getting the license, tremendous excitement for all the team and, of course, our UK customers. Of course, just getting the license is only the start. And as you rightly said in your intro, what we wanted to do was, in the success that we've been very privileged to have in the UK, a number of our customers have also, Charles, we love the ClearBank experience. You get sterling. When can you give us other currencies? And so what about clearing and payments and embedded banking in euros, in US dollars and others? Euros was always the target. And in order to be able to provide those same services in Europe, we needed a banking license, which post-Brexit we can't do out of the UK. You've got to have a proper bank within the EU. And we chose the Netherlands, and we finally have the license, which now, to the extent of the excitement, starts where we can start delivering all of those payment, clearing, settlement, and embedded banking services to our clients in Europe, starting with the Netherlands. But of course, as we all know, Europe also is not one overall country. It's a number of countries, but all different rules and the rest. But that allows us now to, without too much technical jargon, passport from the Netherlands in France, Germany, and other countries in Europe, and start providing pan-European services in sterling. So yes, very exciting in relation to, of course, getting the license in the first place. But more importantly, what does it mean for all of our customers and also our international expansion strategy, where Europe is the first milestone for that as we take the business globally.
Yeah, no, a huge move. And as you say, I'm sure an absolute ton of work in the background for the whole team. So kudos to the whole team. I'm aware that our listener base is very broad, and we have people that have worked in financial services all their life and people that may be quite new to the space. So for people that have not come across the concept of a clearing bank before, like, where do you guys sit in the ecosystem, and what is it that you guys are enabling maybe that incumbents have been struggling to do?
Yeah, it's a great question, because if you like, we say it all the time, or every bank does, but we got a unique business model in actually we don't do retail banking, we don't do business banking, we don't loan money. And you sort of thought, well, that doesn't sound like a bank to me. But when we set it up 6 years ago, essentially, and that strat line, exactly what is clearing? Well, there used to be 16 clearing banks in the UK going back. And those essentially are connected to all of the payment schemes. And essentially, you take a payment to one of those clearing banks, and they will clear that payment through the UK clearing system every day. So the things, again, and apologies about the jargon, but I hope some of this people can relate to, faster payments, right? So you'll get online banking, you make a payment, and that's within 2 hours. They're called a fast payment. But of course, you do lots of other things like standing orders and direct debits. And for higher value payments, like those lucky enough to buy a house with your solicitor, a CHAPS payment. So we got lots of different channels in relation to payments in the UK. And in order to be a member of those payment schemes and be able to do it directly, you've got to be a regulated entity. And so what we do essentially is we built the very latest tech. We took Microsoft Azure cloud technology. We connected it to all the payment schemes. And we have an API that you can put your payment to, and we will do the rest real time for you. As compared to doing that with a Barclays or Lloyds or the other 4 clearing banks that are left now in relation to legacy technology, very clunky, slow, not real time, et cetera, et cetera. And so with the fintech revolution coming 6 years ago, did you really want to build all that fantastic front-end tech servicing customers and then connect it in the payment side of the back end to legacy, almost batch technology? Instead, connect it to our API, and actually we'll put it through the payment schemes. But in order to actually do all of that, you also need to hold the cash, and that's where you need the banking license. And so all the payments of that we hold in our bank accounts, and we hold every penny at the Bank of England 100%. So our balance sheet today is now coming up to £9 billion all of which sits at the Bank of England and is the money that all of our 240 live financial institutions, all their customers' cash, all sits at, and not a penny of it moves. So as I said, we don't have any lending. We don't have any other AAA assets that aren't AAA when things go wrong. So to the extent if everyone emptied their bank account at the same time, all of the cash, that 9 billion, is sitting there and could all instantaneously go back, unlike the SVB type situations, or indeed Northern Rock, or all of the other banking crises. So how do we make money out of that? Well, in order to become a customer of ours, essentially open a bank account, you put cash in it, we put it at the Bank of England. We charge you monthly fees for all the different banking as a service, clearing services we provide. We charge you wholesale per transaction. And then, of course, on a reducing basis, that cash we earn interest, Bank of England overnight, and we give you a share back that interest. And so very much a transaction model rather than the old banking model of a banking book, valuing like Barclays or Lloyds, or essentially the 0.6 of their balance sheet as their valuation. We valued more like a fintech and multiple of transactions that put through. And of course, the whole play is that the platform, we chose it for real time. We chose it for volume. It can connect to all the payment schemes all around the world. And it's a volume play. The more volume we put through all our payments, essentially the more money that essentially our investors will actually make. But we're providing all those services back to all our customers on speed, efficiency, innovation, and all of those things. And this is the first step, essentially. And now euro and sterling on the same platform, we can make it much faster, more efficient, remove costs, friction, all of that cost and FX. All of those are now actually benefits. And as we add more payments schemes around the world, more currencies, that magnifies for our global customers.
Exciting times.
Sorry, quite a long answer to you, but hopefully that gives a bit of a flavour of the type of business that we're in. But it's the back end, if you like, unsexy part of banking, but actually is so important, especially when things go wrong.
Yeah, no, absolutely. And you can't have a sexy front end and then decrepit systems beneath that. Like if we want to see the innovation we want to see in the financial services system. Kyle, love to loop you in. What's your take on this news? How big an impact do you think this will have on the fintech financial services ecosystem as a whole if companies like ClearBank can start to expand elsewhere?
Yeah, well, I think we've thought a lot about the sort of end state for a lot of banking solutions, both in the US and globally. And for us, actually, fully getting your license to actually be a regulated financial institution is sort of the end holy grail because of what it enables you to do from a sort of controlling your destiny standpoint, particularly around risk management and who you can actually service. On the flip side of this, we've seen the struggles of Evolve and Synapse and what that model can create in the States here. And, on the flip side, Charles, correct me if I'm wrong here, but it feels to someone on the outside as though a lot of the success that ClearBank has had and will continue to have is because of just how much of that infrastructure stack you own. So, it's a super impressive milestone. And yeah, I think now the expansion globally is incredibly exciting. I think, for any startup ever, winning your core market is essential. And it takes a lot of folks, 7-8 years at times to truly win that core initial focus. And, once you reach that milestone though of then having earned the right to expand, whether that's, your ICP or additional product lines or additional geographies, that sort of becomes, almost a phase 2 of the business in our book. And so, very, very exciting times overall.
Maia, I haven't asked Charles explicitly whether he plans to expand to the US. I don't know if I've time to do it. And he said the word globally, so I guess I'm assuming the US might feature in that, given it's kind of a big deal globally. What would your reaction be if ClearBank was to rock up on US shores? Do you think they'd have an impact?
As you know, the US market is really big, is really different. I think particularly we talk, right, Charles is like, oh yeah, it took us 18 months to get a banking license in the Netherlands. I think it would probably be longer or more expensive or more complicated or all three of those to get a banking license in the United States. The regulatory environment for bank license is totally different. And I think we've seen a couple UK companies come over and try to just deploy the same playbook and kind of fall flat on their face. So I would totally welcome Charles to the U.S. market, but I think the same playbook isn't going to work in the U.S. as it does in Europe.
So just to help on that, I'll give a little bit more in relation, because you're quite right, Kate, of being asked that question. We've already done quite a lot of groundwork without giving too much away in relation to the US entry strategy. And to directly address the last comments made, what we're looking at, I've been quoted as saying this before, is exactly, we think it would take us 3 years to actually potentially get a backlog. So the more efficient way, and particularly an overseas coming into the US market, is actually a minority to control transaction. So buying an existing US bank, you can't buy it outright. Take the minority straight, you work with a management team and then move to controls, you keep the regulators happy, etc. Potentially 18 months, 2 years type transaction of buying a US bank that's already got a Fed reserve account, is connected to FedNow, ACH, essentially a small community loan book or whatever it is in relation to that, with a clean regulatory reputation. Use that, deploy, buy that, or move to a control, and then enter that way in relation to working with the US regulators and existing management and all of that. And obviously, to Carl's comments, we're very aware in relation to obviously all the US issues, or Synapse or all that have gone before in the BaaS market, fintech market, whether it's Column, Cross River Bank, the various regulatory issues that already exist in this space. So we are very disciplined, very controlled. We're not going to the US to conquer the US market. We're going there to access US payment rails via a banking license, but actually do it properly, rather than some of the issues that the US is facing. So it's great to hear, but in doing that, we think we can do it in a much more controlled way that would actually work and fit the US market, rather than going there. So many UK companies go and spend a load of money on the rest and then get burned, fire them everyone, and then come home with losses, right? So no intent to try and do that.
Come home with losses, but probably great US snacks, which for me is always like the kind of key part. Like when I saw like that you'd picked the Netherlands, I was like, Stroop waffles makes complete sense. Like I'm totally on board with that. Again, massive congrats to the team. Super excited to see kind of what you do now you've hit this next milestone. And if you do move into the US, obviously we'll have to get you back on to chat about that. But
thank you so much.
But yeah, we're going to have to move on to our next story because, as we said at the top of the show, it is a busy week. So our next story comes from FS Tech, and that is investment in UK fintech nearly triples. UK fintech investment hit £5.7 billion in the first half of 2024 as the market recovers from the worst of the economic downturn. That's up from 1.95 billion in 2023. These figures are still down compared to the funding records set in 2021, with KPMG suggesting that investment is more subdued due to stubbornly high interest rates and inflation. According to KPMG research into the funding, this figure is the result of fewer deals than this time last year, 198 compared to 284. But the deals were much higher value, including a $621 million raise by Monzo and a $999 million raise by Bound. Again, lots of investor experts on the panel today, so I will absolutely defer to you guys rather than my own perspective. But Kyle, let's loop you in first. What did you make of these figures?
Yeah, it's interesting, and I think one of the last points there is maybe what I latch onto, and that there's such a stark distinction in fundraising trajectories between deal count and deal size, where when you get companies that progress to these later stages that are really high quality businesses that are on very high quality trajectories, like those warrant raising a lot of capital, and really the timing around when those companies actually raise is more down to the intrinsic value of those companies and when they choose to raise than timing the market per se, which as it should be. And I think the comparison maybe to 2021 is, and maybe our biggest takeaway internally has been, it feels like the companies that are getting funded now, especially at the growth stages, are those that truly deserve venture capital. There are an absolute ton of businesses out there that are absolutely worth building, that have very strong teams behind them, that just don't quite have the total sort of scale of opportunity that us venture investors are really looking for. And it feels like a couple of years ago, maybe a lot of those were still receiving venture funding. And I think now, especially at growth stages, investors are certainly a lot more discerning about exactly what they're looking for as far as quality and thresholds that folks have to meet. So I'm not surprised that these funding numbers are really skewed by a smaller number of absolutely massive rounds when total deal count has dropped. But again, it's always interesting because these reports always lag where the market actually is today. Funding rounds take at sometimes weeks to, if not years even, to actually be announced publicly. And so they are certainly a good approximation of where things are headed. But it'll be interesting to see how those numbers continue to shake out over coming quarters. It definitely feels like deal volume on the early stages has picked back up to a certain degree. And I don't think that's really showed up in the public numbers yet. And so we'll see if that starts to change over the coming quarters.
Okay. No, I think that's a really interesting point because that was my initial concern, right? When you see these stats about the skew towards larger deal size, you worry that some of those earlier stage fintechs are just going to not get funding and that we might see kind of this delayed impact on the sector as a whole if we're not kind of seeing that flow through from early stage businesses. I mean, Maia, are you seeing kind of a similar picture in terms of those early stage businesses still getting the funding, or what's your take?
Yeah, I think, I'm going to say the same thing that Kyle said, but in a less professional way. I think investors are hungry, right? And even you heard it in Kyle's intro at the top of the show. He's like, we are open for business, right? Very much open for business. What I hear is Kyle's like, dude, my checkbook is open. Give me a good company to write it to, and I am ready to invest. So I think people are hungry. They're hungry for investments. That said, fintech has been through some rough times recently. And so there is kind of this flight to quality where they're less willing to take a risk. You've really got to have it proven out. The other thing, right? Kyle was saying, look, Monzo's such a good business. Abound is such a good business. They can choose when they raise money and aren't dependent on the market. And those rounds are they're so big, right? They're it's almost 50% of the delta compared to 2023. It's like between 40 and 50%. That as much as I want to celebrate fintech funding is back, I worry that it could just be a data artifact, right? We had two big quality companies that just so happened to raise in H1 of 2024, so that everything looks really great compared to 2023. Maybe this is indicative of a trend to the upswing, but maybe some favorites, Monzo and Abound, just happened to raise then. So that's a concern that I have with this news.
Yeah, no, absolutely. Charles, obviously, I know you guys are in international expansion mode, but as you said, you've been rooted in the UK fintech financial services space. I suppose one way of interpreting this data is that the UK fintech sector has been more durable than other markets, or it could be, as Maia says, just we've had a couple of big UK firms that have just chosen this time well. What's your perspective? Is the UK different, or is this an anomaly?
No, I think it is, and for a number of reasons. I'm privileged, if you like, as part of the Unicorn Council and co-chair of the Unicorn Council at Innovate Finance, representing the industry and all the work we've done policy-wise with the government and now the Labour government in the UK. And a few sort of anecdotal bits of evidence to come back to Carl's point. And in fact, yesterday I had lunch with a series of CEOs, but also a headhunter that specializes in M&A corp dev. They have never seen the last 2 months. They've now more mandates for H2 in relation to M&A and corp dev resources, where companies now want to deploy, do M&A, and actually want to write the checkbook, as you heard earlier, and a number of PE firms. And I always worry as whether it's estate agents talking up the market or not. But anyway, I think I've heard it in a number of places now. There are deals that are underway that are actually not in the public domain. And there is a lot of appetite to do a lot more in H2. I think that's really encouraging. And I've, Rachel Reeves and doing the rounds, the certainty in relation to Labour government. In the UK, 30th of October, the worry about capital gains tax for overseas investors and the fintech community, we've been lobbying hard in relation to that. Please don't equalize the income tax rates, right? If you want the inward investment, there's a lot of it to come. And actually, with the certainty across Europe compared to the other European centres, the UK is actually looking quite good for a change. Post-Brexit, that was definitely not the case. So I think there's a lot of factors in relation to the UK and that pent-up demand, where obviously all the PE firms and the rest only are starting investing in their own portfolio companies, and all the new startups were being squeezed. I really hope that it comes through, but there's a lot of soundings that I'm hearing about activity in H2, and therefore it's not just big deals or the Revolut headlines, right, or Monzo's or whatever, are the true fintechs getting it. And remember, the UK government needs growth. There's a final stat that I quote. If you added up all the fintechs in the UK, in terms of valuations, we would represent 25% of the FTSE 100, right? It's a serious sector for a government to actually generate growth.
Well, and in the US market, I'm kind of seeing the same flight to quality trend in early stage, which is I've seen a lot of companies that they're just starting out. They have nothing, right? I mean, they've got like an interesting idea, maybe a pitch deck or a memo, quality team that people are excited about, and they're raising on really good terms. They can raise $2 to $3 million at like a $15 million valuation, despite fintech being a little bit cloudy recently and despite investors being a little bit hesitant. And that's because I think all of the investors who do that early stage investing are reducing the number of deals, and they're concentrating all of these all their capital into these quality bets that they think are a little bit less risky.
Kyle?
Yeah, totally. I think and that's me. It's a bit of an interesting sort of dichotomy, because when pervasive sentiment is that the market is maybe a bit trickier, a lot of even early stage venture investors sort of, there is this shift to quality. But Maia, to your point there, what that often means is it's a shift to taking less risk, realistically, where you want to bet on founders who you have really been there and done that before, or in a business model that you really know and understand, which isn't inherently a bad thing. But at the same time, as early stage venture investors, like, we're in the business of taking risk and then systematically trying to mitigate that risk.
Totally. It can lead to less innovation.
Exactly.
It can lead to biases. It can lead to like all kinds of interesting downstream things.
Totally.
Maybe lead to overpaying for deals, right? So they're taking less risk, but they're also getting less reward. Like, I think we'll see all these interesting downstream effects.
Totally. And to that point as well, a lot of the bar at growth stages seems to have concretely risen, where you actually do have hard metrics and financial data to where you can create sort of arbitrary thresholds around the technicalities of the financial profile that you're willing to invest in. At the early stages, those just simply don't exist. And so at the same time, there's probably less growth deals that even meet those thresholds to get done. And so what that's created is a lot of these growth stage or multi-stage funds have just consistently gone earlier. And so certainly at seed right now, the market feels as active and as competitive as it ever has. Maybe you don't get quite the same amount of just utterly insane seed rounds that were taking place in 2021, 10 on 80 posts or something like that, which is ridiculous. But certainly there's a ton of activity. And I think it's funny to see the distinction there between, how much is going on at pre-seed seed and even early Series A versus, growth rounds being just that much harder to get done.
I think this is such an awesome blend of both like pragmatic, this is what investors are looking for, this is the reality of raising, but also optimism as well. And we haven't necessarily been in a position to have that balance for a little while. So really, really awesome insights. Thank you. Annoyingly, because I could talk about this all day, we're going to have to take a very quick pause here. We're going to be back very shortly with our next stories. Welcome back. Before we dive back into the rest of the show, we wanted to let you know that nominations for this year's 11FS Awards are closing soon. On Thursday, 7th of November, we'll be celebrating the people and companies that have been transforming the fabric of financial services over the last 12 months. There are 11 awards, surprise, surprise, up for grabs across 5 categories, including Best Use of AI, Fintech for Good, and Consumer Game Changer. The deadline for submissions is midnight on Wednesday, the 21st of August. So if you're listening to this before then, quick! Have your say right now at 11FSAwards.com. And if you're listening to this on Thursday, you'll just have to wait until next year. Now, back to the news. Okay, our next story, again, we're taking this one from TechCrunch, but it's been covered in a few places. This is $855 million valued fintech Tally has shut down. Tally, a consumer fintech that offered solutions for credit card debt, have announced they'll be shutting up shop after 9 years. They were backed by the a16z venture capital fund and raised $172 million in a series of funding rounds over the last few years. The San Francisco fintech has run into trouble over the past year, first pivoting away from its consumer product and focusing on B2B. But CEO and founder Jason Brown announced on Monday that Tally hadn't been able to secure enough funding to continue. So I guess, yeah, we had a lot of positive chat before the break. This is a slightly sadder story, sad news. Tally got a big valuation, got some pretty serious investment. Maia, why do you think it's failed?
So, couple of thoughts here. Rumor on the street is that they kind of got screwed by their capital partners and that their line of funding dried up from that perspective. And so they had to last minute kind of switch to lending off of their balance sheet, which sucks. And if you look at, I saw the SF Gate reported that Tally was brought to its demise by consumer complaints. I actually don't think that's the case. I think what happened is with rising interest rates, they really struggled to secure lending capital, and that you can see it. You can see that evidenced in the consumer complaints. So I went and looked at the Better Business Bureau. They've gotten dozens of low complaints. It's actually been almost 2 years since they've had a review that's higher than 1 star. And that was November of 2022. They had a 2-star review. So consumers are mad. A lot of empty promises. They're raising interest rates on them, and they're struggling. And I think, I think the Tally team is really great. I think they were really trying to improve people's lives, improve their financial health, do right by them. So I don't think they were trying to screw people over with high interest rates. I think they just found themselves backed into a corner. This is what they had to do. Consumers were upset. They probably, weren't that happy. And ultimately, they can't continue the business. So it's definitely a bummer. I mean, it was a very high-minded startup, right? Tally was trying to help people get out of high-interest credit card debt and help them consolidate those loans. And I'm bummed that they couldn't find a way to make it work in the current interest rate environment.
Yeah, no, I think bummer is definitely a good way to describe it. Kyle, I mean, people might, again, look at some of these numbers from these previous raises and think gosh, that's a lot of money. Where did it go? You talked earlier, I think, about the scale of opportunity being kind of a key thing for investors to look at. Have Tally maybe just kind of not been able to tick that box or kind of communicate that story? What's your perspective?
Yeah. So I don't want to speculate about their underlying financial position as far as the scalability of their sort of revenue figures, but I think in this sort of situation, they were clearly growing nicely, especially in the early years, which is a prerequisite if you're going to raise that amount of capital. I think maybe one of the more impactful shifts at these sort of growth stages, though, is, and Charles, you maybe alluded to this in your intro here, but it is around the way that these companies are actually valued. And so there's for early stage investors, there's always a scarcity problem where there are only so many great businesses and it pays to be involved in them in some capacity. If you get into public markets, though, scarcity is not a concept. It's public markets by definition. And so the only way that businesses are valued is based on, the actual intrinsic, fundamentals of how they're actually doing. And so somewhere at the sort of growth stages, you really start having to take into account, what public markets investors are actually going to think of these businesses. And when, public lending multiples have come down, certainly in the fintech world, as much as they have, the actual valuation methodology has shifted from, this might be a big winner that, who knows what what's the sky's the limit for these guys, and valuations are still, an output of dilution versus now, they're maybe being valued on book value potentially. There's likely a pretty decent, overhang or delta between now what the intrinsic value of the business would look like if they were a public markets company versus, the promise of them being one of these, really unique startups that actually, has worked to a certain degree. And so again, when that shift in valuation methodology really kicks in, it becomes very difficult if you've overraised at prices that don't become sustainable. And I don't know exactly where all these jumps were priced, but we've seen this happen across a number of sectors. Lending and insurance being another one. That it just becomes difficult to grow into these prices if they're the multiples that you're raising at are really dramatically different than where you'd be valued in public markets.
Charles, what was your reaction to this news?
Disappointing, but understandable. Whilst we've been talking very positive, there's still pain out there. There's stress and there's pain in the fintech land. And if you like, I suppose I'm slightly biased, but the consumer side, all right? So we're very much B2B. You talked in your intro about pivoting from, B2C or B2B or whatever it is. You can't, in the C side of it, and you're in lending, you got to know what you're doing and you've got to have the right funding base. Seen it so many times in relation to small banks then trying to grow their credit books and actually needing the capital to underpin that. And it's got to be there, right? Whatever you're doing, even if the proposition, where theirs was actually quite strong. But unless you've got a sustainable earning stream, and you've got capital funding to grow, very, very difficult to build these side of businesses. Obviously there are other factors, right, in relation, as we've heard, right, consumer sentiment and complaints, and you just pile on the rest. And it becomes a self-fulfilling prophecy in relation to, you haven't got the right sentiment, you can't get the funding when you need it, etc. And there's so in all these businesses, are you raising money when you don't need it? If you have that luxury, but in startup, it's very hard. So very disappointing. My mind, actually, again, warning factors, this financial discipline, capital funding for when you don't need it, particularly if you're in the credit business. And consumer, right? It's a risky place.
I know. What I liked about them is so many Americans are hounded by debt collectors, debt consolidators, like all of this kind of seedy underbelly of the financial services industry. It tends to be kind of ignored by people who found companies and by investors because they are not the demographic that gets hounded by debt collectors. And so I was really rooting for Tally. I was like, here's a company that gets it, how big of a problem this is. And they're coming up with a 21st century solution to debt consolidation and refinancing there. But they didn't make it.
I think it's, I mean, I also think it sort of speaks to some of the wider challenges in like financial service business models more broadly, because when you look at the picture for American consumers, as you said, like huge problems with debt. And actually, if you could consolidate that debt, help people to pay it down faster, it should open up opportunities for customers to put that money into savings, to buy new products, to kind of grow those customer relationships, that lifetime value of your customer in different ways. But you've got to kind of trade that off against the short-term revenue bump of like a crazy APR that's raking in loads of money for you in that single year or whatever. So I think we're really struggling because you can see there is an opportunity here if you can help customers to have this better relationship with their credit and to then channel their credit usage in more positive ways into products that can kind of, again, grow and scale over time. But it's difficult. I think it's really hard.
That's true. Yeah. From a business model perspective, like they might have been creating a ton of value for their customers, but it's not clear how you capture that value, right? You're saving people a ton of money, both maybe right now and certainly long term over their lifespan. But because you're saving them money, it might not feel like it's actually extra money in their pocket. It's hard to really make a lot of money as a business like that.
Yeah. And this is why I was sort of hoping, I think maybe the B2B pivot maybe came too late. Like as you said, Maia, like those complaints were already in. There are obviously challenges in the business model, but maybe kind of my hope, the hopeful kind of tail end to this story is maybe that this idea doesn't get lost. Maybe this technology doesn't get lost. Maybe it can get acquired by a bigger player in the States who might be able to bring it into a broader financial offering where they can start to, as you say, make that saving on the credit card repayment, but then channel that fund into another part of their business and make the kind of business model work more effectively. But always sad to see any fintech close down. Have to remember that there are obviously customers impacted by this. There are employees impacted by this who will have really dedicated a lot of time over many years to trying to make this work. So I suppose we'll keep our fingers crossed that the technology survives, that these employees can find other businesses that can leverage their talents, and that consumers are not suffering too much as a result, because these are vulnerable customers already in a difficult space. So fingers crossed. Okay, on to our next story. This one is taken from Fintech Global, and that is Google partners with GoHenry to develop Tap to Pay for kids. Regular Fintech Insider listeners might remember that only a few weeks ago, actually, we were talking about Australian bank Westpac offering debit cards to 8-year-olds. Well, Google is taking kid-focused finance to the next level as they partner with UK Fintech GoHenry to enable Tap to Pay capabilities. This is a US exclusive service that will integrate Google Wallet into their Fitbit Ace LTE wearable device, a paired-back Fitbit device aimed at kids. The idea is to leverage Google's wearable tech, but with safeguards in the shape of GoHenry's services to allow parental oversight over spending and promote good money management. I believe they are also partnering with Greenlight in the US as well. But I suppose, Maia, we were talking before the recording started about the challenges of young small humans. Are you going to be giving your small human a payment-enabled Fitbit anytime soon?
I actually love this idea. I think it's really cool. But back to our last story about business model, that's always my struggle with fintech products for kids is where's the business model, I mean, banks' traditional business model is net interest income. The fintechs don't have that. They're not really banks. The GoHenry card, I think specifically, is issued by Community Federal Savings Bank. They're not earning that much interchange revenue because kids don't spend that much money. So that leaves you, it's like you've got a subscription play, you've got trying to monetize their parents, right? They're not doing any lending. I actually think the product sounds really cool. I bought an Apple Watch for my mom for her birthday because I know how much she loves Tap to Pay with the Apple Watch. Like, it's cool to be able to just walk around and pay for things without having to get your wallet out or to get your phone out. And I think for kids, we don't want them to have a cell phone. Having a wallet or a debit card to carry around is really dangerous. The Fitbit actually seems a really elegant way that you're tracking their sleep, you're tracking their steps, and it lets them buy something. So I actually think the product is really cool. I have concerns about the business model, and I have some concerns about, given the way that the fintech rails really work, how those controls on spending, how effective those will be. But I think the high level pitch is awesome. I love it. My kids are 2 and 6 months. So I think they're a little young for a product that's intended for 6-year-olds at the minimum. But we'll see. Maybe in the next couple of years, there'll be something even cooler.
Yeah, you get to kind of ride out the first release and kind of let them get the gremlins out of the system, and then it'll be ready by the time you're 2-year-old. It's 6th birthday season. I suppose, to your point around what is the business model here? Again, I think it speaks to some of the interesting shifts we're seeing in this market as a whole. I spend quite a lot of my time speaking to people in large incumbent banks in the UK and in other countries, and the kind of big thing they're all worrying about is where does the next generation of customers come from? Actually, the fintechs are stealing all of stealing. That makes it sound like they've done something wrong. They are rightfully gaining through enhanced offerings, attracting younger customers in their droves. And so a lot of these incumbent banks are thinking, how do we stay relevant? How do we make sure that all of our customers don't just very slowly and sadly disappear? I think it's a harder thing. Again, it's creating a challenge, I think, within the kind of really senior echelons of these financial services organizations, because it's not something that you can kind of calculate in the same way. It's not about a product that pays off over 2-3 years. This is about how do you remain relevant as an institution for the next 10, 15, 20 years? And so it's a much longer mindset. And I think that to me seems like it must be driving a lot of this. I know that GoHenry was acquired by Acorns. Acorns obviously have this play, they do pensions, they do kind of all that stuff in the longer term space. So I can sort of see why it made sense for them. But Charles, what's your take on this one?
Well, actually, I know Louise and I have been on panels a number of times. The financial literacy side and all that, really exciting in terms of sort of kids and learning. All of us can relate to that. And my own daughters, and actually I've got grandchildren now as well, of actually teaching them about money, and particularly, although I say it, the evil of credit, right, in terms of being brought up of you only buy what you can afford to. Rather than the rest. So all of that side, I think, is absolutely brilliant. I agree with Maia's comments. I think the idea and product is really cool. It's really exciting. Your Acorn point, I don't get the monetization aspect. I think it's very difficult. So the other thing I'll talk to Louise about is, but what happens at 18, right? Why aren't you thinking about the stages? I meant parents, but how do you retain them? So all the exciting stuff as a kid, as a 6-year-old, what about when they're 18, going to work, university, and keeping them, right? And where's the business model then? And obviously they're being acquired. So I agree. The second point, though, I'd make in relation to our wider hatter on sort of embedded banking and new models and the rest, and the large banks being what I think that's a really good one. This is part of it. We're doing more and more. We've got more and more innovative embedded banking solutions, which is threatening the big four. I'm an advisor on the advisory board in relation to what hopes to be one of the most ESG banks in the UK, Richard Theo, in relation to Zero, where the Gen X and generation, actually they love using all the Starlings, Monzos, Revoluts functionally in terms of their cards and transactions. What if there was an emotional connection as well to actually doing it? And so Richard's idea with Zero, for example, is actually, if I'm passionate about sustainability and saving the world, I can do my payments and banking through Zero as a bank in relation to that. And actually I can feel good about all their lending is eco-friendly, net zero, all of those things. And I actually have a greater relationship with the payment or the function of my brotherly card or Monzo card, whatever it is. But I think you're absolutely right. What through those generations, that fintechs with brilliant ideas and brilliant products, the old incumbent banks, they should be worried, because this is not about a 1-2 year game. It's about a 5-10 year game, and that sustainability will that change. So great idea, great product. Unless you can cross-sell, or you've got other things like worry about sustainability and profitability of the product.
Kyle, do you share these concerns, or are you seeing the trajectory here?
Yeah, I think I share most of the viewpoints that have been shared already as far as in the underlying model. I think maybe what's interesting to me about this story is pretty much every major payments innovation of the past 15 or 20 years really in the US has been about decreasing friction to pay in any sort of circumstance whatsoever, whether that's via different mediums, whether that's different financing methods. It's really just making that process far easier for the consumers. And to me, this feels like continued evolution of that, where the world of what finance and payments is contained within just continues to broaden, which I think is really cool overall. I don't think this is, right out of the gate necessarily going to be something that, is a major reason to be bullish on Google as an institution. But but I think it's a cool product, and it's cool to see, the continued proliferation of just how we can actually apply the world of finance.
Well, on the low friction, the pitch is very cool, right? Oh, it's so easy. Like your kids are just going to wear this Fitbit all the time and be able to buy the things they need to buy. I worry that it's not actually going to work that well. When I hear things like spend controls, my guess is what they're doing is they are allow listing specific merchants or specific MCC codes or dollar amounts. And that stuff never really works that well, right? Like if you want your kid to be able to shop at a grocery store, but not at other places, and you allow list those merchant category codes, and then they go to a convenience store that's attached to a gas station, and the MCC code is a gas station. So they're trying to buy snacks and it's not working. The person at the register is like, what's this kid trying to pay with this gizmo? The kid doesn't know what's going on. They don't know what's going on. They want their snacks. The person's like, sorry, you can't have those snacks. Your payment isn't going through. Like, that sounds really frustrating and really annoying for everyone involved. And we're like, if they've reached their spend limit, then that's kind of one of my hesitations is he's got this dream of like, oh yeah, kids could be independent and buy the things that they need without spending too much money or in the wrong places or having it stolen. But the actual realities of the way that the financial system are set up, you can't know the specific SKUs that people are buying. You don't know if they're buying candy at the grocery store or vegetables or toys. I think means it's like actually not going to be as compelling as the pitch sounds like from a high level.
Yeah, no, I think those all feel very fair concerns. And as the legally responsible person for a 3-year-old, I just think like it's going to get broken, it's going to get bashed, it's going to get lost. Like, I know, I think anytime you have a dependency on a single form of payment, you open yourself up to huge amounts of risk, as you say, that in the moment you need it, it's not going to be there. So yeah, we want a huge opportunity, lots of excitement. But yeah, so similar to what I was saying for you, Maia, I'm kind of hoping that this has been through a few iterations by the time I have to actually make a choice about whether I put one on my son's wrist or not. Okay.
But sorry to interrupt, but how are you all teaching your kids the value of money, right? So it's making it easier to make a payment, right? Actually, my granddaughter, teaching her, giving her pocket money and actually spending it when it's gone. And working out the numbers and various other things. So maybe that's a really old-fashioned view, but just as Maia was talking about in spending limits, 6-year-old doesn't, what they understand is the money box is empty, or they run out of cash in their pocket, or mum and dad's wallet is empty, right, or the credit card limit. And so you want all these things, but you can't have them, right? You've got to live within your means. And sorry, some of those old basic values, whatever, the generation of I want it now. I'll use any credit product and they'll bank with mum and dad and I want it now.
Well, and like sometimes tech people are like, cash, that's so old fashioned, right?
Yes, exactly.
It's like not to like, it's so dumb. And they don't realize there's actually so many values to working with cash, like all of the embodied cognition that comes with understanding, like more money, it weighs more in your pocket. You can feel it as you buy things, you're holding less weight. All of that is like actually really rich data for ourselves and really important when educating kids.
So important. Okay, again, I feel like we could talk about this for a lot longer than we sadly have time to do. So I'm going to move us on now to a couple of the more click-worthy news stories that we didn't have time to cover at all in the show today. So I'm going to wrap us up through those very quickly. Main story in this section comes from The Verge. Again, lots of different places, and that is Apple set to open up tap to pay on iPhone. The tech giant has announced that it will finally allow developers to tap into NFC or near-field communication tech in its phones to allow peer-to-peer payments from third-party apps. This is part of Apple's upcoming iOS 18.1 software, and it enables functionality that's always been exclusive to Apple Pay and Apple Wallet. So iPhone users will be able to map a contactless payments app of their choice directly to the side button on their phone. This is pretty hot off the press, so I must admit I've not had time to kind of go read all the small print of this, but definitely a really exciting opportunity. We know that regulators have generally been putting a fair bit of scrutiny on the closed Apple ecosystem. So if you're being cynical, you could say this is jumping before they're pushed. But in doing that, they are in theory getting to do this much more on their own terms. And my understanding is that developers will have to pay fees to access this still, which I think they've still to announce. But given how popular Apple's tap to pay offering has been, as Maia was saying, buying the Apple Watch for a mum, this could be huge for other platforms to have access to. And it looks like this will initially be rolled out in the UK and the US, but Brazil, Canada, Australia, and Japan are next on the list. So change is coming in lots of places, and we'll be keeping an eye out to see who are the biggest beneficiaries. Okay. And finally, a look at something a little more lighthearted from the world of finance. So this week, we're looking at a story from TechCrunch, and that is Score, the dating app for people with strong credit scores, shuts down. The credit-conscious dating app was set up by the financial wellness platform Neon Money Club and was pitched as a pop-up app that was only supposed to be around for 90 days, but user interest meant that Score stayed online for 6 months. In its short life, the app attracted 18,000 users who made between them 8,000 matches, and Neon Money Club has gathered some interesting data along the way, including a gender credit score gap, which is as much as 11% among millennials. Well, I mean, I don't really know where to start. I mean, has anyone used this app? Maybe that's an awkward question. I don't know what people's relationship statuses are on the panel. I should have checked before we started, but yeah.
I haven't used the app. I get the idea. I want to say that I like the idea of dating people with a high credit score, but that said, I've sort of committed my life to somebody who does not have a good credit score, and so I guess I'm wrong about what I think I want in a partner. And I wonder how many other people are kind of in that same position where they think it might be indicative of like shared values, or personality, or something more than it really is. Which, I'm always saying the credit score, people like to use it as like a number that quantifies their self-worth. And really, it's an approximation of how good you are at paying back debt. And like, that is it. And in relationships, how important is that? Like Dave, right? Dave doesn't like debt. He doesn't take out a lot of debt, doesn't want to pay it back, just wants to pay for things with money he has. To Charles' point about financial education, like that's actually pretty great. He doesn't have a good credit score because of that, because he hasn't taken a lot of debt and demonstrated a history of paying back lots of different types of debt over lots of different situations. But from my perspective, like, is a pretty fine attribute of somebody to be in a relationship with.
Yeah, that was going to be my next question, Charles, actually. Like, where does like dating someone with a high credit score come on your list of like financial life lessons for your kids or your grandkids? Is this like...
Well, it's really interesting because my daughter, her boyfriend, we've been together, 2 or 3 years now. They actually met on a vegan dating website. I didn't know there was such a thing. And coming back to Maia's point about values and shared values, she became a vegan, etc. She was a vegetarian. Now she's gone all the way, become passionate about it, which makes it very hard for my wife and I and others. Like, we're cooking 10 different meals in terms of oil. It's all great and it's fine. The important point was, though, that actually a boyfriend is actually a bomb disposal captain in the army, who actually can't get decent vegan food through the army, right? The Navy doesn't, what do they serve is tomatoes. Sorry, I got right off topic. But the topic is that shared values in a relationship, and actually they're very happy together. Both being vegan, it matters more than, if you like, his credit score. He happens to own a house and have a mortgage and very responsibly financially. To me, the life lessons, I'll be very fortunate. I've been married 38 years. I'm very happily married, the same partner, etc. And again, when we first met early on, of course, credit scores nothing to do with that. And her father sort of thought that I might have potential. Maybe he was right or not. But anyway, I don't see, biases we try and get rid of, and your mind uses the credit score for all these other things that person is. I think it's a good idea. I think there's better matches for relationships.
I mean, I think your wife's done pretty well for herself. So I think we can say that now. So I think she's made a good choice. Kyle, I mean, this was initially an experimental app, but it got a fair few users. Would you be looking at this thinking there's an idea here? Like, get some, you said your checkbook was open. Is it open to this?
I don't think this is gonna quite be one for the funds here, but no, it's interesting. I think as the world of dating has progressed, the level of customization over like your shared most important traits has just continued to proliferate. So Charles, it's cool to see that for people who really do care about being vegan, there's a place where you can actually go find that. I was home visiting my parents over the winter holidays last year, watching a show with them, and there was probably a string of, over the course of maybe an hour or an hour and a half, there's like 10 or so different commercials for different very niche dating apps. And so, I think which is great at the end of the day. Like maybe not the most venture backable, but I think if you can actually help people find what they really are most looking for in other people, that's great. Now, it's certainly a fair question if the sole trait that you should be looking for most in other people is their credit score. Who am I to judge? But
it's also, I don't think this was ever supposed to really be a business or even a standalone app. I think it was kind of a marketing play for Neon Money Club. And from that perspective, it's probably pretty successful, right? Because I don't think, is it a good idea? Actually, when we dig into the details, maybe not. Is it a good business? It seems like almost certainly not a venture scale business. But is it a cool marketing play? Like the vibe of it is like, hey, you are a striver, you are ambitious, you are successful, and you should associate yourself with other people in that category. And that's what Neon Money Club is about. So come sign up for art. Like that kind of makes sense to me. I actually signed up for the Neon Money Club Cream card recently, and I signed up, I got approved, and they said like, cool, we'll let you know when we're sending it out. So I almost wonder, and I'm just making this up, I do not know anything, but I wonder if the fintech side of their business is kind of going slower than they expected. They're waiting on approval from their bank partners or from their card partner, and they haven't got everything built out yet. And so they're like, we got all these engineers. We can't be onboarding customers to our main product. Like, what could we do to generate hype and consumer interest for what we're building in advance of it really existing and launching? And if the answer was like, it's kind of a fun idea, right? Like you could imagine a creative team coming up with this idea of a dating app that uses your credit score for like a Super Bowl ad, and they just actually made the ad or they actually made the product, and that is their ad. So I think from that perspective, like, I get it. It's cool. I like the branding, like come join fellow ambitious strivers, even if I have some doubts about the specific tactics of a dating app for credit scores.
Yeah, no, fair enough. I want to give the final word to our listeners because we polled our LinkedIn audience asking them if, would you date someone with a low credit score, and found that our readers are largely happy to compromise. So 46% say that they would have an honest financial chat with a prospective partner about their credit score. 19% are hopeless romantics saying they keep dating, love wins, and a heartless 18% said end it. So there we go. A very, very representative sample. Okay, well, sadly, that wraps up this week's Fintech Insider News. Thank you so much to today's guests. I've loved hearing all of your perspectives and insights. So where can people find out a bit more about you and your companies? Charles, what about you?
Yeah, LinkedIn, actually, with the European news, it's been pretty hot in relation to LinkedIn, but obviously ClearBank at Charles McManus, and old-fashioned email address, charles.mcmanus@clear.bank. So that's me. Very happy to take any feedback or anyone wants any help. I'm always there to give advice or share our experience to help others.
Brilliant. Thank you so much. Kyle, what about you?
Yeah, our portfolio and sort of our fund strategy is up on foxcapital.com. We're very active on LinkedIn. Feel free to reach out. Always love having conversations with fintech enthusiasts, and Kyle at foxcapital.com.
Brilliant. And Maia, what about you?
Come hang out with me on Twitter. Everything I do is on there. I'm at Maia B, MAIAB, and I have open DMs, so you can feel free to send me messages. Let me know what you thought of this episode. But yeah, I talk about all kinds of fun things on Twitter all day, every day.
Brilliant. Go check it out. And as for me, Kate Moody, you can find me on LinkedIn, Kate Moody, or drop me an email at kate@landfest.com. Thank you so much for listening. If you like what you've heard, please follow the podcast and don't forget to leave us a review. It helps us to make a better show and helps others to find it. And if you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or you can email podcast@landfest.com. Thank you very much. Goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.